Are oil prices in China rising against market trends? This critical question has recently taken center stage in discussions among Chinese consumers. As per a recent adjustment notice issued by China's National Development and Reform Commission, the retail price of refined oil in China saw an increase of 20 yuan per ton, taking effect from midnight on September 6. This is another notable increment following the August 6 surge when the retail price of refined oil crossed the significant 8 yuan per litre threshold. Data indicates that prior to this modification, oil prices in various provinces were predominantly above 8 yuan per litre. Particularly the region of Tibet and Hainan recorded the highest figures, with 92 gasoline retailing at 9.54 and 9.23 yuan per litre respectively. Netizens commented that the last time the oil price surpassed 8 yuan was 2 years ago, at which point the price of crude oil exceeded $120 per barrel. Furthermore, when the international crude oil price was $150, the oil price was just over 6 yuan. However, this time, despite the international oil price dropping to $84, the domestic oil price has surged to over 8 yuan, which is quite strange. Chinese officials assert that this pricing strategy is a measure to counteract the rising international oil prices and fluctuations in the domestic supply and demand dynamics, aiming to stabilize market prices and safeguard the equilibrium in the energy market. Nevertheless, the simultaneously decline in international crude prices contrasted with a surge in domestic refined oil prices raises eyebrows, leaving many wondering about the true catalyst behind this trend. The primary cause is seemingly tied to the Chinese Communist Party's aggressive financial policies. According to recent data revealed by Russia, January saw a record export of 3.8 million tons of oil to China, with prices oscillating between 72.51 and 83.67 dollars per barrel, excluding shipping costs. Earlier, Western nations had set guidelines limiting the purchase price of Russian oil to below 60 dollars per barrel, given Russia's role in disturbing global peace. Moreover, Russian oil exported to other nations has been priced well below the threshold set in Europe and America, even reaching as low as 35 dollars per barrel, inclusive of shipping costs. Despite these international trends, China persists in procuring vast quantities of oil from Russia at premium global prices, even as other Asian countries steadily halt their imports from Russia. This strategy has led to speculation among Chinese netizens that China is indirectly channeling financial aid to Russia amidst its invasion of Ukraine, thereby disrupting domestic oil prices and undermining the welfare of its populace. Many believe this is a move likely to incite backlash from refined oil consumers. The second reason clearly points to the declining profits of state-owned enterprises such as Sinopec. On August 27, the Chinese state-owned enterprise Sinopec released its financial report for the first half of 2023, which indicated that Sinopec's net profit plummeted by over 20% in the first half of the year. The semi-annual report highlighted a double decline in the performance of Sinopec during the first half of 2023. The report showed business revenue of approximately 1.6 billion yuan, a 1.1% decrease compared to the same period the previous year. The net profit attributable to the parent company's shareholder was 35 billion yuan, representing a year-on-year decline of 20%. Within the financial report, Sinopec's debt ratio also saw an uptick. In 2022, the asset-liability ratio was 51.8%, a slight 0.29% points increase from the figure reported in the previous year. This increase might seem insignificant, but is quite substantial given Sinopec's total assets are almost 2 trillion yuan. In an attempt to reverse the diminishing return, Sinopec embarked on a significant venture on July 5th. As documented on its official website, the company forged a $720 million contract with the Saudi Arabian oil group, Aramco, for the Emerald project, a strategic move conceived to enhance business performance. The contract marks the highest value refining engineering general contract independently undertaken by Sinopec in the Saudi region. Despite these maneuvers, market faith appears unswayed. Sinopec's stock plummeted to a concerning 65% by July 10, landing at a value of 6.44 yuan, a stark decline from its peak valuation of 18.51 yuan. Although there has been an upward trend in the stock price, rising by 53% from 4.21 yuan since early January, it fails to mask an embarrassing fact. Early investors who ventured into Sinopec in 2007 have not only failed to reap any benefits, but have also incurred this loss of 65%. Apart from Sinopec, the China National Offshore Oil Corporation, CNOOC, the principal offshore oil and natural gas producer in China, has reported downward financial trends. The recently published semi-annual report of 2023 indicated a 5% contraction in revenue, registering at 192 billion yuan, accompanied by an 11% nosedive in net profits, tallying at 63.76 billion yuan. Attempting to salvage the performance of state-owned enterprises through price hikes at the expense of Chinese consumers' interest is indeed a tactless move. Interestingly, a broad spectrum of netizens are filled with queries regarding why enterprises like Sinopec are facing a downturn in performance. Netizens have highlighted a news item from Malaysia which has sparked a heated debate. In stark contrast to Sinopec's performance decline, Malaysia's state-owned oil company Petronas breached the significant threshold of 130 billion yuan in net profits during 2022. Not only domestically, but also on a global scale. Petronas showcases prominent advantages. Reportedly, the gasoline retail price set by Petronas is about 3 yuan per litre, a price considered friendly in many developing countries. Meanwhile, in 2023, China's gasoline price have skyrocketed to over 8 yuan per litre, even setting a record with 9 consecutive increases in oil prices. Despite the notably low prices of gasoline, Petronas managed to secure profits around hundreds of billions. This highlights the substantial profits that industries like Sinopec can potentially generate, while domestic prices for resources like petroleum, gasoline, diesel, and natural gas continue to escalate. Enterprises like Sinopec announced a decline in performance, causing significant losses to early investors. Sinopec attributed the slump in performance primarily to the decrease in international crude oil, refined oil, chemical products, and other petrochemical product prices, coupled with reduced sales of chemical products. Moreover, the recent revelation of the 2023 Fortune China Top 500 companies portrays a grim economic landscape. The top 3 companies are Sinopec, PetroChina, and China State Construction Engineering, followed by China Railway in the 4th position. These are all state-owned enterprises. In the 5th position was Ping An Insurance, securing the highest rank as a non-state-owned enterprise. In terms of profits, Sinopec ranked 6th. Despite securing the top position in the ranking, Sinopec's plummeting profits and huge losses underscores a broader narrative of economic hardship unfolding within China's borders. Despite its reputation as a financial powerhouse, Sinopec has been grappling with regular declines in profit and even recording losses, a scenario that starkly contrasts with the individual gas stations that are enjoying a surge in profits. This ongoing situation has led many to question whether this is normal. Reports indicate that Sinopec's financial performance this year is not meeting projections, even falling behind the figures noted during the pandemic-stricken period of 2022. Market analysts warn that this downturn could potentially have adverse repercussions on the company's stock prices and overall market valuation. Aside from industry structure and market influences, some netizens believe that the decrease in Sinopec's earnings parallels the long-term robust operation of China's tobacco system, despite continuous losses, highlighting potential opacity in the accounting mechanism of state-owned enterprises. This might also be the third reason for the increase of China's finished oil prices against market trends. Despite a dip in net profits in the first half of the year, Sinopec has maintained a generous dividend distribution strategy. According to a recent announcement on August 27, the corporation plans to dispense cash dividends of 0.145 yuan, tax inclusive, per share for the 2023 semi-annual period, based on the total share capital of 119.9 billion shares as of June 30th, 2023. The proposed distribution accumulates to a hefty sum of 17.4 billion yuan, including tax, maintaining a substantial cash dividend rate of 49.5%. In addition to declining profits, state-owned corporate giants have often found themselves embroiled in controversy. On June 7th, a top executive, Hu Jingyong, was spotted in a compromising situation, openly walking hand in hand with a mistress during a business trip in Chengdu, Sichuan. This scandal, which quickly went viral, provoked a widespread investigation frenzy where both individuals were suspected to be affiliated with the China National Petroleum Corporation, CNPC. The episode spiraled further as a woman involved was seen carrying a handbag valued at over 40,000 yuan, around 5,400 US dollars. CNPC's Beijing project management company announced on the 7th that Hu Jingyong has been removed from his position as the executive director, party committee secretary, and the general manager of the global project management company, and is under investigation by the company's disciplinary committee. Subsequently, the WeChat official account of the enterprise was voluntarily cancelled. Sinopec, being a sibling group of CNPC, was also put under the spotlight, with netizens conjecturing that the profit decline is because the money was spent on supporting mistresses. Employee benefits at state-owned enterprises like Sinopec have always been a focal point of public attention. Recently, a netizen posted a payroll of a frontline equipment staff at Tianjin Sinopec. It detailed that the employee receives a monthly housing provident fund of 4,700 yuan, a corporate annuity of 600 yuan, and a pension insurance deduction of 1,600 yuan. On top of this, there is a medical insurance deduction of 500 yuan, an unemployment insurance deduction of 100 yuan, and a provident fund deduction of 2,050 yuan. All this is on top of an average monthly salary of 7,800 yuan and 2 annual bonuses amounting to 88,500 yuan. The annual net salary amounts to 180,000 yuan, around 24,600 US dollars, not including the pension fund, which is more than 9 times that of employees in private companies. This highlights the substantial income enjoyed by the higher echelons in PetroChina. Moreover, a worker from a Sinopec refinery in the south disclosed their enviable salary details. This employee, a third-level sergeant, transferred to an auxiliary position with 15 years of service and working on a 2-day on, 3-day off schedule, takes home about 9,200 yuan, around 1,250 US dollars monthly. Additionally, they receive a provident fund of 3,400 yuan, a beginning of the year bonus of 3,000 yuan, a mid-year bonus of 4,800 yuan, and a year-end bonus of 46,000 yuan. The employee also receives around 5,000 yuan in vouchers for occasions like birthdays, National Day, and the New Year, in addition to high temperature and heating allowances, accumulating to over 160,000 yuan, around 22,000 US dollars, in total yearly take-home pay. Despite the attractive benefits, securing position in a state-owned enterprise is extremely challenging. A Chinese news report on June 28 mentioned that several PhD graduates from prestigious institutions like Tsinghua and Peking University applied for positions at PetroChina, with 470 individuals vying for a single administrative position, making the chances of securing the job akin to winning a lottery. While competition is fierce, people are notably reticent about discussing the cryptic rules governing recruitment into SOEs. Despite passing the initial academic selection, candidates' prospects hinge largely on their background connections. a phenomenon that has become widely accepted among the Chinese populace. Over the years, the opacity and the non-transparency surrounding the financial operations of these SOEs have sparked recurring debates, with instances ranging from Sinopec's purchase of exorbitant liquor for executives to the distribution of diluted problematic oil. All of these factors are testing the limits of citizens' tolerance towards a systematic corruption embedded within the Chinese Communist Party's governance. In an effort to bring the intricate power structures behind PetroChina and Sinopec to light, the Oilgain anti-corruption movement uncovered the involvement of former senior leader of the CCP, Zhou Yongkang, and Zheng Qinghong of the Jiang Zemin faction, raising suspicions that these corporations might be cash cows for the Chinese Communist Party. On March 26 of this year, Sinopec took steps to salvage its reputation by incorporating anti-corruption assessment criteria into its performance evaluation system, linking results to various aspects including remuneration, position, and rank adjustments. These assessments primarily focused on management's adherence to anti-corruption responsibilities, support for supervisory bodies in performing their duties, and accountability scenarios. Nonetheless, the Chinese public seems well acquainted with this strategy, displaying diminishing trust in the so-called verbal anti-corruption pledges made by the state enterprises and even the government. Indeed, the recent street photography incident involving PetroChina's top executives serves as a glaring example of the systematic failures of these anti-corruption measures in Chinese SOEs. The implicated mistress, who garnered multiple outstanding employee recognitions within half a year of her employment and accompanied the executive in numerous work events without attracting attention from relevant supervisory bodies, showcases the inefficiency of these anti-corruption systems, the reason for which remain unclear. Hence, the establishment of these mechanisms raises concern about a possible say one thing, do another attitude. In a significant development this June, the Chinese Communist Party initiated a brief anti-corruption campaign targeting PetroChina and Sinopec. Key figures, including PetroChina's former deputy general manager, Xu Wenrong, and Vice President Li Xiao voluntarily surrendered, while others like Jiang Jieming were arrested. The deputy secretary of the party committee and general manager of China Petroleum shared operations. Gong Lixing is under investigation, as are Li Duo, the former party committee secretary and general manager of China Petroleum Zhejiang Sales Branch, and Ren Jing, the former party committee member, chief accountant, and original chief accountant of Sinopec Shandong Petroleum. This series of investigations, encompassing several executives from both companies, sparked sarcastic comments from netizens who jokingly attributed the persistently high oil prices to the leaders' accumulation of wealth. Some said, "We have finally identified a problem cause for the market anomalies."